Hello everyone and welcome to lesson 3 of the Blueprint course. Today we'll be focusing on timeframes and how to incorporate them into your market analysis. I will walk you through a 3-step process. We call it multi-timeframe analysis. That will help you pinpoint location, clarify direction or trend, and improve your market timing. We will also dive into the big brother, small brother principle, along with anticipatory trend analysis, so you can develop a more nuanced approach to reading the markets. Let's get started. This 3-step process, known as a multi-timeframe analysis, will be your companion throughout your trading journey. Whenever you analyze a market, any market, you will follow these steps: location, direction, and timing. Let's start with step 1, location, which forms the foundation of your chart evaluation. We start by looking at the higher time frame, often called the big picture, to see if the market is expensive, cheap, or in equilibrium. Recall from lesson 1 how we split the chart into 3 zones: excess demand, cheap; excess supply, expensive; and equilibrium, neutral, to decide if we should buy, sell, or remain neutral. You have probably heard the phrase buy low and sell high, but defining low can be subjective. That's why we rely on a rule-based approach to determine whether the current location is suitable for buying or selling. Think of it like real estate. Location is everything. So you want to know exactly where to buy, where to sell, and when to stay out of the market. Moving on to step 2, direction, still using the higher time frame. In this step, you identify the prevailing trend, whether it's up, down, or sideways, combined with location. This broader perspective helps you decide if conditions are favorable enough to move forward. Only when the location and direction align, say a low price zone in an uptrend, do we proceed to the final step. That final step, step 3, zoning, takes place on a lower time frame, LTF. This is where you set your specific trade parameters, your entry, stop, and target. If the location suggests prices are cheap, the direction indicates an uptrend, and you spot a high-quality demand zone, you'd look to buy using your set, stop, entry, target parameters. By following these 3 steps, location on the HTF, direction on the HTF, then zoning on the LTF, you will maintain a consistent, logical framework for analyzing and executing trades without letting emotions get in the way. This 3-step process applies to all financial objectives, whether you aim for daily, weekly, or monthly income from trading. The only real difference is the time frames you will use. If you plan on holding trades for months, you will focus on larger time frames than you would for weekly or daily income. Here at OTC, we specialize in long to mid-term investing, so weekly and monthly income strategies. But we will still occasionally use daily income methods, depending on the situation. Ultimately, it's up to you to decide which income goal or trading style best fits your lifestyle and your preferences. The good news is that our core principles work across all time frames and income approaches. That way, you can choose a style you're most comfortable with while still applying the same consistent method. Take a look at this slide, which lays out the exact higher and lower timeframes for each income stream. Let's start with daily income. Here, we use daily charts as our higher time frame to determine location and direction. Then we drop down to anything between the 480-minute to 60-minute charts for more precise entries and exits. Moving on to weekly income. In this case, the weekly chart becomes our higher time frame, giving us a broader view of location and direction. The lower time frames then include the daily, 960-minute, 840, 720, or 600-minute chart. Personally, I rely heavily on weekly income trades. using weekly and daily charts, and occasionally checking the monthly chart for extra context. This big picture perspective helps confirm my strategy and improves both the likelihood of success and the risk to reward ratio for monthly income. The monthly chart itself is our higher time frame, offering the most comprehensive outlook on market direction. The weekly chart serves as a lower time frame in this setup, even if you are not actively trading monthly income strategies. Paying attention to the monthly time frame is essential since it reveals the larger directional flow of the market. For instance, I avoid taking a daily trade that conflicts with what I see on the monthly chart because that bigger context significantly influences price movement. You don't need to memorize all the specifics right away. Feel free to snap a screenshot and refer back whenever you need. The main idea is that larger timeframes typically hold bigger imbalances and more significant unfilled orders, which can increase the probability of successful trades. Keeping an eye on monthly insights, even when you are trading shorter term setups, ensures you stay aligned with the market's broader trends. Now that you understand the three-step process and know which time frame to use at each stage, it's time to put the theory into practice and discuss how to properly conduct location analysis on a chart. Take a look at this sample chart, where certain areas are marked in red or green, expensive or cheap, and a gray area in between for equilibrium. How did I arrive at this distinction? How can you view every chart in terms of high, low, and balance? Let's break down the steps for identifying location. Step 1. Identifying the first fresh supply zone on the higher time frame. The emphasis here is on the word fresh, which we will explore in more detail later. To find this first fresh supply zone, move up and to the left from the current price, hopping from one candle to the next until you spot a leg out, a base, and a leg in. Once you locate that zone, you have your first reference point for determining whether prices are expensive, cheap, or somewhere in between. Step 2 is all about finding the first fresh demand zone on your higher time frame. Just like with supply, we will follow specific rules for zoning. We will rely on the preferred version of zone placement discussed earlier, where the leg out doesn't need to be explosive, just decisive. We will also check for freshness based on that preferred version, allowing it to be tested by no more than 25% of the zone. To identify our demand zone, we start at the current price, then move down and to the left on the chart until we identify a clear leg out, followed by a base, and finally a leg in. If we can't locate any zones nearby that meet this criteria, we have an alternative guideline. Everything that looks like a level is a level. Essentially, we never want to buy at a retail price or sell at a wholesale price. We'd rather buy at wholesale and sell at retail. Though, we'll refine this approach further when we talk about direction in a later lesson. Once you have identified a supply zone above the current price and a demand zone below it, you then divide the range from distal to distal into 3 equal sections, creating 5 segments on the chart that span from very low to very high. I'll give a quick demonstration of how to do that, and then we'll move on to the practical application part of this lesson. Once you see it in action, step by step, it will all click into place. Let's just take a moment to reflect on why identifying location is such a critical step in our overall analysis. Remember from lesson 1 that our goal is simple: buy low, sell high, and avoid trading when price is in equilibrium. A rule-based approach to determining location helps us objectively assess whether an asset is expensive where we want to sell, cheap, where we want to buy, or in equilibrium, where we should stay away. Beyond just identifying price levels, we also want to align our trades with the support and force of institutions. Having our lower timeframe zones inside or near higher timeframe zones significantly boosts the probability of success. This alignment creates a synergy between the big picture and the finer details, increasing the odds of the trade working out in our favor. I will revisit this concept shortly, but for now, let's walk through the steps we use to identify location. Before we jump into the charts for a practice run, let's quickly recap what we have learned about identifying location. This slide acts as your rules card. It's straightforward and to the point. Step 1. Find supply on the HTF. Step 2. Find demand on the HTF. Step 3. Divide the area between them into 3 equal parts. That's all it takes. By following these 3 simple steps, you will have a solid foundation for effectively determining location on any chart. Feel free to take a screenshot of this so you can revisit it later. A few more points before we head into the practical application. First, these are your rule cards for zoning on the higher time frame. Notice that the base, in other words, the zone, is drawn using the preferred version, and it must remain fresh according to the 25% rule. Also, the leg out only needs to be decisive on the higher time frame. On the lower time frame, by contrast, we look for an explosive leg out. Finally, if you can't find a zone that meets this criteria on the higher time frame, we have an alternative rule. Anything that looks like a level is a level. This ensures you always have a reference point, even when a strict interpretation of the rules doesn't yield a clear zone. Let's jump into the charts and do the entire process together. Welcome traders to my practical application. Today we will talk about location. Okay, where's current price located? Expensive, very expensive area, equilibrium, cheap, or very cheap area. We'll go into the charts here with our Campus Fund Trading platform. That's TradingView. We can analyze and execute all of our trades here. Here guys, I opened the Euro US dollar on the monthly time frame. The monthly time frame is the highest time frame and also the most important time frame, most powerful time frame. Location. We have to check where's the current price located, right? And for that, first step is to identify the first supply zone. For that, we have to looking to the left and to the upside without cutting any candles, and we have to wait that we hit a leg out candle. Explosive, decisive, right? Any leg out candles. And let's start together. Here, price, or we can add a line right here at the top and then go to the left, and you can see, oh wow, we hit an explosive candle. Oh, that's a picture perfect leg out candle. More to the left, another picture perfect leg out candle. And here, 1, 2 clear indecisive candles and a picture perfect leg in candle. That is our drop, base, drop, supply formation. Great, that was really easy. Let me add the proximal and distal line. We are using the preferred version for that. Look at this. This is our first supply zone. Great. The next step is to identify the demand formation, okay, the demand zone. Current price is here. We have to go to the downside, looking to the left without cutting any candles. Let's go. First, we go here, right? We hit this candle. That's definitely explosive. This one is decisive. Okay, we have a lot of leg out candles. We are looking also for indecisive base candles. We need this. Leg out candle, another leg out candle, and then look at this, indecisive. This one is decisive or almost explosive. All this here, right, that looks like a formation. Remember, we have an alternative rule for location. Everything what looks like a level is a level. And for me, and I think also for you guys, this one looks like a formation, right? For me, that's a clear level like this. It is a drop, a base, a rally. But there's not right or wrong. Again, everything what looks like a level is a level. Here, you can also go with the idea of this is your proximal line, the right place for your proximal line, and all the way down is the distal. That is a drop, all of this is a base, and then you can see the rally. This is our rally here, a drop, base, rally. Looks definitely that there are institutional unfilled, or there are more institutional unfilled buying orders in this area, right? Look at this rally. That's so dominant, so powerful. Here, for the location, our job is not to refine a zone, right? We will not trade this zone. How to trade location zones? We will learn this later. Here, it's more like to identify the imbalance between buyers and sellers. Our job is to identify institutional unfilled buying and selling orders. And I think you guys agree, right? That's definitely supply. And here, all of this, everything what looks like a level is a level. This is our demand zone. Great. We identified supply. We identified demand. And now let's add more areas between the distal, the supply zone, all the way down to the distal of our demand zone. I will add the Fibonacci tool again and distal to distal. A little more accurate. Okay. Change the settings. And look at this. Now we have 5 areas in total. This one here, our initial supply zone, is a very expensive or very high area. Okay. If we are located or current price, if we are located with a current price, do this a little more accurate. Okay. So, if we are located with a current price in the very expensive, very high area, yes, we are looking for a short opportunity. A little bit lower, this is an expensive or high area. If we are located here, it's the same. Yes, definitely, we're looking for shorts. If current price located lower here, all of this, okay, yes, then that is the equilibrium, okay? We have to wait that we are in the extremes or follow additional rules later on. A little bit lower, here, this is the cheap area. If we are located here, we are looking for a buying opportunity, okay? And this one is a very cheap area. If we are here, definitely would like to buy, never sell, never sell. Okay. Look, where is current price located? You can see it is exactly between the expensive and equilibrium. We can wait. I will press the play button in a second and then you will see, okay, where will go the price, right? It go higher or a little bit lower. But remember, we are here on the monthly time frame. That's the most powerful time frame, okay? Whenever we hit, or we are in this, not we hit, whenever the price is located in these extreme areas, here or here, right? We have to take action. We have to buy here and we have to sell here. The monthly time frame, or always on location, we expect that price is moving from supply to demand or from demand to supply. Let me press the play button. And let's wait. Ah, look at this. I paused it now. You can see now we are not in equilibrium or a little bit in the expensive area. We are definitely in the expensive area now. And let's wait. And boom. Look at this. Here we hit also the very expensive area, our supply zone. We are filling now institutional unfilled selling orders. That's the reason why we got the drop. right? That's the reason. We filled more and more institutional unfilled selling orders. The idea is, again, monthly time frame, its location. We are moving from the supply all the way down to the demand. And we're expecting here the same. We're filling more institutional buying orders, right? And then we should see more strengths. Let's wait a little bit. You can see we got already a drop, right? Now a little bit stair-stepping. We are waiting that price will hit our zone here. At the moment, we are in the cheap area, not in the very cheap. And now look, wow, that's powerful. You can see we're filling more and more orders. That's the reason why we got the wicks also in our very cheap area. And look, more and more strength. That's amazing. Let me pause this one. That's a nice example, right? Price will move from supply, in this case, all the way down to the demand area. And yes, it was a right decision, right? Or the location was correct. Price was located in the expensive area, later on also in the very expensive area. And yeah, we are looking for a short opportunity all the way down. That's great. Great traders. It was a practical application about location. See you in the next one. Now, let's look at one of the most interesting concepts in trading, a technique that has proven to be a reliable tool for identifying high probability setups in supply and demand. The big brother, small brother principle. As always, we begin by determining location using our higher time frame, HTF zones. This gives us a broader perspective, not just on current price, but also on how lower time frame LTF zones fit into the overall picture. Take a look at this example. We have a lower time frame supply zone, but it sits right in the equilibrium area of the higher time frame. That lack of alignment makes it a less appealing LTF zone. We wouldn't trade it because the context isn't ideal and the risk to reward would likely suffer when starting from equilibrium. On the other hand, we see a lower time frame demand zone that aligns perfectly inside the higher time frame demand zone. This is a high quality trade opportunity because the LTF zone, the small brother, matches the HTF zones, the big brother, overall location. When both zones are in sync, the probability of success climbs and the potential risk to reward improves significantly. That's the essence of the big brother, small brother principle, ensuring your trades on the lower time frame are supported by the bigger picture on the higher time frame. But why is it so powerful? By definition, the big brother, small brother principle applies when a lower time frame zone sits entirely within a higher time frame zone. Essentially, it refines the larger zone on the HTF by pinpointing the exact origin of the imbalance on the LTF. This setup boosts the probability of success because you're aligning your trades with the broader market forces evident on the higher time frame. And it also offers a potentially smaller risk window from entry to stop loss. That combination can significantly improve your overall risk to reward ratio. It's important to highlight that even when the big brother, small brother principle is in place, it does not guarantee a successful trade. There are several reasons why a trade might fail. First, we could have made an error in the higher time frame zoning, such as misidentifying supply or demand, or we might be trading against the direction of the higher time frame trend. Second, the quality of the zones matters. Both the higher time frame, big brother, and the lower time frame, small brother zones need to be of high quality. High quality in both location and the LTF zone gives us the ideal setup, increasing the probability of success. This brings us to the next point. Direction or trend is the second step of our multi-timeframe analysis, and we will explore it in the next lesson. It is one of the most critical parts of our analysis because trading a lower time frame zone against the trend of the higher time frame significantly increases the likelihood of being stopped out. Lastly, it's crucial to remember that trading is ultimately a game of probabilities. Even with the best analysis and setups, one of those probabilities is always a stop out. Losing trades are as much a part of trading as winning trades and taking profits. The key is to maintain discipline, follow your process, and focus on the long-term results rather than any single trade. Now, let's dive into the charts again to take a look at a real-world example of the big brother, small brother principle. Welcome traders to our practical application, and now we will talk about the big brother, small brother principle. Let's go into the charts. Again guys, we will use our Campus Fund trading platform. We can execute and analyze all our assets here. That's TradingView guys. Okay, let's go into the chart. And this is the GBP Japanese yen on the weekly time frame. Remember, we will start here with the location, means always the HTF, the higher time frame. Step number one is the location. The idea of the big brother, small brother principle is that two forces will push price in one direction. And the two forces are here the big brother and the small brother, means higher time frame, lower time frame. Okay, let's go into the charts. Again, location is the first step, and here we will start with the first supply zone. Remember, on the previous practical applications, we have to go from the current price to the upside and to the left without to cross any other candles, right? We are looking now for a proper leg out candle, explosive. Okay. Step by step, here's nothing guys, right? It's not a proper formation. Here's nothing. And then look, we will hit this candle here. It's a nice red candle, another red candle, a clear drop. That's definitely leg out. Let's go to the, or let's highlight this zone first. Here, that is definitely a leg out. Where is our leg in? That is here. And you can see we have now two candles between the leg out and the leg in. You can see the second candle here, that's not really indecisive. It is more decisive. Could also be a leg out candle. Means this one is our leg out, this one is our basing candle, this one is our leg in candle. Great. We identified our first fresh higher time frame supply zone. Let me highlight this now. Don't forget guys, we remove first the vertical lines. This is our first supply zone, right? Remember, for location, we have to use the preferred version. This one is a wider version. We will not move the distal line. We have to move the proximal line, and from the bottom of the base candle to the bottom of the body of our basing candle. That means that is our basing candle, right? This is our supply zone. Great. Next step is to identify the first demand zone. Let's go back to the current price. That's here. And now we have to go from the downside and then to the left without crossing any candles. We are looking for explosive or multiple decisive candles. Should abnormally bigger than the surrounding. We need a fresh level here. Let's go step by step. Go lower, then we'll see this. That's explosive, yes, but not really indecisive. Let's get lower, absolutely not explosive. Let's go more to the left. Here, it's a clear leg out, but not really abnormally bigger than the surrounding, right? Next one, absolutely not explosive. This one is more indecisive. And here, look at this. We'll hit now this candle. That is amazing, right? A nice explosive, abnormally bigger than the surrounding. That's great. Where is our leg in? The leg in is here, right? We have also multiple here. between two indecisive candles, means this is our base. Let me highlight this for us. Let me remove the vertical line, it's easier to see. Okay, this is our demand. But again, don't forget, for location, we have to use the preferred version, not the wider. Means we will not touch the distal line, only the proximal line from the highest point of the base candle to the highest point of the body's base candle. Well, like this. Great. It's also absolutely fresh. It's never tested, right? And the same for our supply zone. Great. We identified the first supply zone and the first demand zone. Next step is to add more areas here. Means I will add this one. I will change with you now the numbers. Remove 0, 1. Add this one here. And now we have to move the lines to our distal, right? The distal of our supply here, and this line to our distal or demand zone. Boom. Okay, now you can see we have 5 different areas. Let me name it. This one is very cheap. This one is just cheap. This one is equilibrium, right? Expensive. And very expensive. Okay, where is the current price located? The current price is located in equilibrium. Means nothing to do, right? We don't want to buy or sell here. But for this example, let's try to move, okay, the current price. Let me add a line. For example, the price is not located in equilibrium. It is located in the second. I have to change the trend line. It's a trend. It's not located in equilibrium. It is located in the expensive area. Okay? Current price is, for example, in the expensive area. Means here the big brother location, right? This preferred supply zone is pushing price into one direction. And now we need the second force. That means the lower time frame, the small brother. Means we will use here now another time frame, the next lower time frame. We will go from the weekly to the daily time frame, and you will check again the supply zone. You can see this one here is our weekly supply zone. And now let's identify, refine the zone, okay? And you will see, I will highlight this here for you. It's a drop, base drop, right? We add these lines, change the numbers here for you. So now you can see the gray, white one is our whole weekly zone, right? That is a big brother. This one is pushing price already to the downside. And this is our lower time frame, our small brother, the blue one here. Means two forces pushing price in one direction now. That's great. And you guys can see, if we compare both areas, both zones, right? You will see the blue one, the small brother, is refined. It's definitely smaller. That means the probability, that means the risk to reward ratio is increased here. The proximal is our entry, our stop loss is around the distal line. Means the risk to reward ratio is increased here. That's great. And also with the two forces, the big brother and the small brother, the probability of success is also increased. That's great. Now let's go into the demand zone. Means, for example, current price is not located in the expensive area. It is more cheap. Okay? We are here in the cheap area located. Means we have to refine now, we have to identify the small brother now in our demand zone. Means here we have to, give me a second, I will go back to the weekly. You can see this is our initial weekly location demand zone, right? Here we'll go again to the next lower time frame. And here I will use daily. For example, you will find nothing on the daily. You can also go lower, 600 minutes, right? 480 minutes, up to you. Let's go now to our zone and let's try to refine this here on the daily time frame. And then here you go. You can see that we have here as well a leg out. Let me show you this with a vertical line. This one here is a leg out, and here is our leg in. It means a drop base rally. Okay, let me highlight this here as well. It's proximal and distal. I will remove the vertical line. You can see the white gray zone is a whole weekly demand zone, and the big brother. And the blue zone is our small brother, the daily, the lower time frame zone. And here it's the same like in the supply zone. You can see that the zone size is definitely smaller, right? Instead of the wider version or the preferred version, of our weekly demand zone. Means we will definitely increase our risk to reward ratio. And again, both forces, the big brother and small brother, pushing price into one direction now. And that is the best of the best. Let me go back to the current price, and then you can see all the zones, right? The supply zone and the demand zone. We reduce the zone size always with the lower time frame. That is the idea of the big brother, small brother principle. Two forces pushing price into one direction, and also we will increase our risk to reward ratio. Great. Thank you for watching the practical application about the big brother, small brother principle. See you in another practical application. Big brothers can sometimes be difficult to identify. Instead of a clear zone or higher time frames, we might encounter a formation known as wick over wick. In this example, take note of how the wicks of two weekly candles overlap. This overlap acts as a key signal. If we zoom into a lower time frame, we often discover a precise level within that range that we can use for analysis. This concept is especially valuable for two reasons. Pinpointing levels. On lower time frames, the wick over wick formation helps us define specific levels for entry, stop loss, or detailed analysis. Higher time frame coverage. Even if there isn't a clear defined zone on the HTF, this overlap provides broader coverage. It gives us additional context or confirmation and can act as a substitute for a big brother zone. So, while we may not see a distinct HTF zone, we can still argue that the wick over wick offers us HTF coverage. This concept bridges the gap between higher and lower timeframe analysis, offering both precision for trade execution and strategic insights for broader planning. It's a versatile tool you will find yourself relying on frequently in your analysis. Congratulations on completing another lesson. Before we dive into lesson 4, I want to remind you about our weekly practical application live class, which includes a dedicated session on location. If you can't make it live, no worries. Every session is recorded and available in the calendar, so you can revisit it whenever it fits your schedule. These sessions are a fantastic way to sharpen your skills. Apply what you've learned in a practical setting and get your questions answered in real time. Check the calendar on the OTC website for more details and exact timings. I look forward to seeing you in the next lesson.